All right, so let's begin the segment. Meet your fund manager, and today the fund in focus will be Nippon India Multi-Asset Fund that has announced the change in its fundamental attributes of Nippon India Multi-Asset Fund. The fund will now be called as Nippon India Multi-Asset Allocation Fund, and currently it is an open-ended scheme that invests in equity, debt, exchange-traded commodities, derivatives, and gold ETFs. And after the change, it will expand to include silver ETFs as well, becoming an open-ended scheme that invests in equity, debt, ETFs, derivatives, gold ETF, and silver ETFs too. Now, the fund house also stated that they are offering an exit window to the unit holders of 30 days from June 24th to July 23rd. And during the exit option period, unit holders not consenting to the change may either switch to any other scheme of Nippon India Mutual Fund or redeem their investments at applicable NAV without payment of exit load, subject to provision of applicable cut-off time and stated in the scheme information document of the relevant scheme. Having said that, the scheme will invest 50 to 80% in equity and equity-related securities, and 10 to 35% in debt and money market instruments, and 10 to 30% in gold ETF and silver ETF and exchange-traded commodity derivatives. No. In case you're thinking that I've got all the information for you, well, yes, we do have the information, but we also have Ashutosh Bhargava on the show today with us, a fund manager and head equity research Nippon India Mutual Fund on board with me. And let's discuss more about Nippon India Multi-Asset Allocation Fund, which will be named from July 14th. So, yeah, I just want to know the reason behind this fundamental attribute change that we'll be noticing from July 14th. Ashutosh, let's begin with this.
Hi, thanks for having me. We think, in terms of commodities, silver in general has a good prospect from near to medium term perspective. And we wanted to include silver ETF to increase the scope of diversification as well as extra return that we can provide through commodity like silver. And that's why this attribution change.
All right. So, Ashutosh, let's also, because we're talking about multi-asset allocation, we also want to highlight the kind of investment and asset weightage that you have in the portfolio. So far, the allocation that we have is equities almost around 53.9%. International ETFs, you have around 15%. Commodity ETF around 12.5%. Corporate bond 6%. Government bond around 5.4%. And then you have commodity futures around 3%. And rest is cash and commodity options, etc. I just want to know that is inclusion in silver ETF. You also have a gold ETF. What is the call that you're trying to take by including silver ETF? It's very good that you have a non-agri aspect to this fund also, and we all know that silver being, an industrial commodity as well. So it's always a double power with silver, precious and the industrial metal benefit that one gets. But overall, looking at your commodity basket, it enhances a lot when you have silver in it along with gold. So what is your view? And even if you have it gold or silver, why do you have it in an ETF form?
So the whole idea is, to bring simplicity in the way we execute this asset allocation. So prior to this change as well, we were having silver as a predominant part of the commodity exposure that we take in this fund. So just to tell you, in this fund, commodities comprise between 15 to 20% of overall AUM. And the internal rule suggests that at any point of time, gold will have at least 10% of the total AUM. Therefore, gold will always remain the dominant asset class within the overall asset mix. It's just that, other commodities like silver, that add to that beta to, whatever gold does. And if we are in a phase where, dollar is likely to decline, gold is to outperform, this is where we have historically seen that silver outperforms even gold. So this is where that extra provisioning, more importantly, other than gold and silver, we have also taken in the past exposure in other commodities also, like crude oil, nickel, etc. So good diversification, which commodity provides, but the overall exposure remains well within the 20% of the year.
All right. Could you also elaborate on the performance of this scheme, which will be benchmark against for all the asset class?
Yeah, so typically it's typically 50% of the fund is into domestic equities, which is actively run. Then another 15-17% is in international equities. There we choose an ETF route. So we invest in MSCI uh, all world ETF, for the simplicity's sake. And that's where we get the exposure of best of the companies from 23 countries. 15%, as you rightly explained, is in fixed income, and rest goes into the commodities, predominantly gold. So that's how the asset allocation mix is. And it's benchmark against a CRISIL benchmark that we have for this particular, for tailor-made for this particular offering.
All right, Ashutosh, let's also talk about your equity, and you've also mentioned about international the ETF, the kind of exposure do you have. In terms of diversification, how important it is for a multi-asset allocation fund to have an international exposure? I mean, we know on a portfolio level, it's really good to diversify your portfolio, but currently international exposure, be it in the form of ETFs, what kind of an advantage do you think it can give to such a fund?
Think of international equities as a separate profit pool versus what you get in India. There are a lot of segments, including in semiconductor, AI, new energy, and some of the top consumer brand. Those kind of profit pool opportunities you don't get in investing in India. India has a thriving profit pool, but it is distinct from what global profit pool has to offer. So that gives that opportunity to participate in that kind of pool. And obviously, there are times when international equity performs better than domestic equity. So there is some bit of this diversification benefit, which also comes by investing in this particular ETF.
Ashutosh, are you fully invested in terms of your cash reserves?
Sorry?
Are you fully invested in terms of your cash
Yes, so
reserves?
we always remain invested fully.
Okay,
Cash
okay.
and fixed income portion put
Sure.
together, that is around 15% of the fund. And rest remain invested, as I mentioned, in international equity, predominantly domestic equity, and 15 to 20% in gold-led commodity exposure.
All right, Ashutosh, so far the portfolio construction looks very heavy towards equity. Any scenario that you might want to consider where you would want to, increase your exposure or weightage on other asset classes also? And what about considering REITs for real estate? Is that also that you might want to look at going ahead?
REIT is allowed in our SID, so we can participate in REIT. In some of the other hybrid funds, we have taken exposure in REITs. So far in this fund, we have not yet taken, but the fund remains open to take exposure in REITs. As far as the allocation is concerned, this is a product where we want to keep it simple to execute, simple to communicate. So the best performing asset class, which is domestic equity, is a predominant part of the portfolio. The another half, the 50%, is well distributed into three different asset classes, which provide that diversification benefit, although it also comes with the slightly lesser returns. So it's very simple, what we call it 50, 20, 15, 15, 50 for domestic equity, up to 20 for international equity, around 15 for commodities, 15 for fixed income. So the end investor always know that what they are getting into without worrying about the sudden change in allocation mix. So we want to keep it simple, and this is actually a unique proposition which we want to offer.
But Ashutosh, uniqueness is really good in a product, but then what about the risk-reward ratio, and what about the risk that might go up because of such a high allocation in equity? How would you like to explain that?
So we need to keep equities between 35 to 65% domestic equity to enjoy the erstwhile fixed income benefit, taxation benefit, which is 20% LTCG for more than 3 years, as well as you get this indexation benefit. So we need to always keep above 35%. Time to time, if the situation would be, this should at least allow us to reduce the equity allocation down. But as I said, this is different from those dynamic asset allocation strategies where you can really come down below even 35%. So it will have equity exposure. Around half of the portfolio will always be in equity. But from our perspective, we are clear in terms of communication that this is the kind of mix that we have to offer.
All right. One more question from the unit holders' perspective. There's going to be this change from July 14, and people who want to be investors, who want to stay invested, do they have to acknowledge to the change in certain way, or that will be automatically highlighted in their investments?
So they do. If they don't want to opt out, then automatically after 1 month, the investment will be status quo. There won't be any change. So if they have to opt out, obviously there has been communication from our side to each and every investor, and they can exercise if they deem that this is a material change in attribution and they want to switch or shift out of this one.
All right, that will be all. Thank you so much, Ashutosh, for being on the show and helping our viewers understand every aspect of this fund and also the new entry from July 14. Thank you so much. All right, time for a quick...
If you like this video, then like, share and subscribe to ET Now.